Welcome to my history channel. This video may feel long, but if you stay until the end, you may begin to understand how one financial firm quietly grew from a small post-crisis startup into a hidden power at the center of the modern world. How did BlackRock rise so quickly? Why did Larry Fink's greatest failure become the foundation of his greatest strength? Why did governments turn to BlackRock in moments of crisis? How did a risk management firm become the largest asset manager on earth? What does it mean when a company becomes a major shareholder in thousands of corporations? Why does BlackRock seem invisible to most ordinary people? And why does its story reveal so much about the structure of modern capitalism? Chapter 1. The Scale of the Invisible Giant. To comprehend the modern financial world, we must first confront a number that defies ordinary human imagination: $10 trillion. This is the volume of wealth managed by BlackRock at its peak. It is a figure larger than the economic output of almost every sovereign nation on earth. It represents the retirement savings of teachers, the treasuries of sovereign wealth funds, and the capital of massive institutions. Yet, despite holding such monumental economic weight, BlackRock remains curiously absent from the daily lives of most citizens. The company operates no retail bank branches on Main Street. It does not manufacture automobiles, extract minerals from the earth, or develop the smartphones we carry in our pockets. Instead, it exists as a meta-institution, quietly holding massive ownership stakes in the companies that actually perform those physical tasks. BlackRock is the largest individual shareholder in a vast majority of the corporations making up the Standard & Poor's 500 index. It is a giant hiding in plain sight, woven into the very fabric of global commerce. This type of scale forces us to ask deep philosophical questions about the nature of financial power. What does it truly mean to manage other people's wealth on such an unprecedented scale? Power in the 21st century is no longer defined exclusively by standing armies or political boundaries. It is defined by capital allocation, by the quiet flow of trillions of dollars directed by algorithmic systems and institutional mandates. BlackRock possesses no military, yet its decisions ripple through global markets with devastating and creative force. We must understand that this immense structure was not built overnight, nor was it designed by a cartel of shadowy figures. It was born a profound psychological obsession with risk, driven by a group of ambitious Wall Street outsiders who believed that chaos could be tamed by mathematics. To understand how the world became financialized, we must trace the path of a single man whose early career reached dizzying heights before crashing into absolute humiliation. Power today does not shout from a podium, it whispers through the algorithms of global finance. Chapter 2. Larry Fink before BlackRock. Long before he became the architect of the world's largest asset manager, Larry Fink was a young, ambitious trader attempting to conquer Wall Street. In the late 1970s, the financial industry was still largely a club of privileged relationships and old institutional traditions. Fink arrived at First Boston without the typical elite pedigree, driven by a relentless desire to prove his worth. He was not interested in merely participating in the markets. He wanted to engineer them from the ground up. At First Boston, Fink became a pioneer in the developing market of mortgage-backed securities. The concept was conceptually brilliant but highly complex. By taking thousands of individual home mortgages and bundling them together into tradable bonds, Wall Street created a massive new engine for capital. Fink helped develop the collateralized mortgage obligation, slicing these mortgages into different tranches based on risk. This financial engineering seemed like magic, transforming boring household debt into highly liquid, institutional-grade investments. The innovation transformed Fink into a star. He was generating massive profits for his firm quickly rising through the ranks at a precocious age. He felt the intoxicating rush of pure market mastery, believing that his mathematical models had effectively eliminated the chaos of human default and interest rate fluctuation. The seduction of Wall Street is often rooted in this exact delusion, the belief that clever equations can outsmart the unpredictable nature of human reality. During these early years, Fink exhibited the classic traits of a young master of the universe. He was confident, aggressive, and convinced that he had discovered a permanent formula for printing money. The praise from his superiors and the tremendous bonuses he earned only reinforced his belief in his own infallibility. But in the brutal ecosystem of global finance, arrogance is almost always the precursor to disaster. The markets were preparing to teach him a lesson about the difference between a model and reality. Ambition can blind a man to the edge of the cliff until he is already falling. Chapter 3: The $100 million Failure. In the year 1986, the foundational assumptions of Larry Fink's financial universe violently collapsed. Interest rates dropped suddenly and unpredictably. When rates fall, homeowners inevitably refinance their mortgages, paying off their old loans much faster than anticipated. The sophisticated models that Fink and his team had built were unable to account for this rapid shift in human behavior. The financial architecture they had constructed began to bleed money at an alarming rate. By the time the dust settled, Fink's department at First Boston had lost exactly $100 million. In the context of Wall Street in the 1980s, this was a staggering, unforgivable sum. The humiliation was swift and absolute. The same executives who had once hailed him as a financial genius suddenly treated him as a toxic pariah. The phones in his office stopped ringing. He was ostracized by his peers, pushed out of the inner circle of leadership, and stripped of his prestige. This period of isolation triggered a profound psychological transformation within him. The loss was not just financial. It was a deep, personal wound to his ego and his identity. He realized the bitter truth about institutional loyalty. You are only as valuable as your last quarter's profit. More importantly, he understood exactly why he had failed. He had chased yield without fully understanding the underlying danger. He had believed in his own brilliance rather than building mechanisms to measure genuine risk. Instead of fleeing the industry, Fink began to metabolize his failure. He vowed that he would never again manage money without a comprehensive, obsessive understanding of what could go wrong. This trauma became the intellectual bedrock of his entire future career. He realized that Wall Street was filled with traders hunting for profit, but almost no one was systematically guarding against ruin. The desire to never fail twice became a dark, powerful engine driving him forward. A truly enduring empire is rarely built on success. It is usually forged in the fires of complete humiliation. Chapter 4: The Founding of BlackRock and the Birth of a Risk System. In 1988, driven by his newfound obsession with risk management, Fink assembled a small team of trusted colleagues from First Boston. This core group included figures like Susan Wagner and Robert Capito, brilliant minds who shared his vision of a radically different financial firm. They needed capital to launch their venture, which led them to the doorstep of Blackstone, the private equity firm led by Stephen Schwarzman and Pete Peterson. They began as Blackstone Financial Management, operating under the umbrella of the larger firm. From the very first day, the culture of this new organization was defined by institutional paranoia. They pitched themselves to clients not as high-flying stock pickers, but as paranoid risk managers who could protect fixed-income portfolios from catastrophe. They promoted transparency, rigorous mathematical modeling, and a deep suspicion of market euphoria. The strategy worked brilliant. Institutional investors, still scarred by the memory of recent market crashes, hungered for the discipline and security that Fink's team promised. However, as the asset management business rapidly expanded, tensions between Fink and Schwartzman began to boil. Fink wanted to distribute equity generously among his founding team and new hires, believing that shared ownership was the only way to guarantee long-term loyalty and alignment. Schwartzman was reluctant to dilute his own stake. This dispute over equity compensation reached a breaking point, leading to a historic separation. Fink decided to take his team and forge an independent path. They renamed the company BlackRock, severing their ties with Blackstone. They quickly secured crucial backing from PNC Bank, which provided essential capital to fuel their growth. By establishing their independence, the BlackRock team solidified their core philosophy. They were not speculators. They were engineers of stability. They institutionalized the trauma of the 1986 loss, weaving it into the genetic code of every employee who joined the firm. To control the future, you must first institutionalize the fear of the unknown. Chapter 5. Aladdin and the New Logic of Financial Control. To truly protect against catastrophe, human judgment is insufficient. You must harness the unforgiving logic of machines. BlackRock understood this decades before the rest of Wall Street. They began developing a proprietary technological platform designed to analyze the risk of every single asset in a portfolio. They named this system Aladdin, which stands for Asset Liability and Debt and Derivative Investment Network. It started as a single workstation in a cluttered office, but it would eventually become the nervous system of global capitalism. Aladdin was designed to perform Monte Carlo simulations, running thousands of hypothetical disasters overnight to see how a portfolio would survive. What happens if oil prices spike by 20%? What happens if a sovereign debt default occurs in Europe? What happens if inflation triples? Aladdin processed these scenarios with cold, algorithmic precision, removing the emotion and ego from investment decisions. It replaced the heroic guesswork of the star trader with the relentless output of a server farm. As BlackRock grew, Aladdin grew with it, ingesting massive amounts of financial data from markets around the globe. The system became so sophisticated and powerful that BlackRock realized they could sell access to it. They began leasing Aladdin to rival asset managers, pension funds, and insurance companies. This was a stroke of corporate genius. By embedding their proprietary risk software into the operations of their competitors, BlackRock positioned itself at the very center of global financial information. This represents a profound philosophical shift in how capital is governed. When thousands of institutions rely on the exact same algorithm to define what is safe and what is dangerous, the algorithm essentially becomes the law of the market. Aladdin created an unprecedented level of standardization, but it also introduced a new kind of systemic fragility. If everyone uses the same lens to view the world, what happens when the lens itself has a blind spot? When an entire industry learns to think through the same machine, the machine quietly becomes the master. Chapter 6. The Financial Crisis and BlackRock's Rise Through Rescue. The ultimate test of BlackRock's paranoia arrived in 2008. The global financial system collapsed under the weight of subprime mortgages and toxic debt obligations. Venerable institutions that had existed for over a century disintegrated over a single weekend. The world was facing an economic abyss. The United States government and the Federal Reserve were desperate. They needed to contain the damage, but they did not understand the complex, opaque instruments sitting on the balance sheets of failing banks. In the darkest hours of the crisis, government officials picked up the phone and called Larry Fink. They did not turn to traditional investment banks because those banks were fighting for their own survival and were tainted by conflict of interest. They turned to BlackRock because BlackRock was a manager of assets, not a speculator trading against clients. More importantly, BlackRock possessed Aladdin. They had the computational power required to decode the billions of dollars in toxic securities held by Bear Stearns and AIG. BlackRock teams were embedded into government rescue operations. They priced the unpriceable assets, managed the portfolios of Fannie Mae and Freddie Mac, and provided the Federal Reserve with the analytical clarity needed to stabilize the market. This period forever changed the identity of the firm. They were no longer just another asset manager. They had become an essential utility for the sovereign state. They had crossed the invisible line between private enterprise and public infrastructure. This blurring of lines raises uncomfortable historical questions. When a private institution becomes so capable and so vast that the government cannot function without it. During a crisis, who is truly directing whom? The rescue operation conferred unimaginable prestige and unprecedented access upon BlackRock. They emerged from the ashes of the Great Recession with a pristine reputation, having acted as the saviors while the rest of Wall Street was vilified by the public. He who controls the mathematics of a crisis inevitably controls the architecture of the recovery. Chapter 7. Mergers, ETFs, and the expansion of global reach. BlackRock did not waste the momentum conferred by the crisis. They used it to execute a campaign of relentless global expansion. Their first major move was the acquisition of Merrill Lynch Investment Management. This brought massive scale and a retail footprint to BlackRock's traditional institutional base. But the truly transformative acquisition occurred shortly after, when they purchased Barclays Global Investors. This single deal radically altered the trajectory of financial history by handing BlackRock the keys to the iShares platform. iShares was the undisputed leader in exchange-traded funds, or ETFs. These instruments represented a quiet revolution in capitalism. Instead of paying high fees to active stock pickers who tried to beat the market, investors could simply buy a low-cost ETF that tracked an entire index, like the S&P 500. As the public lost faith in high-priced Wall Street managers following the crash, trillions of dollars flowed out of active management and directly into passive index funds. BlackRock positioned itself to capture almost every drop of this massive capital migration. They offered ETFs for everything: large tech companies, emerging market bonds, sustainable energy, and gold. The seduction of scale here is absolute, because passive management relies on algorithms rather than highly paid analysts. The profit margins grow exponentially as assets under management increase. BlackRock effectively became the default plumbing for global savings, siphoning a tiny fraction of a cent from billions of daily transactions. This shift from active to passive investing fundamentally rewrote the rules of ownership. By tracking the indices, BlackRock was forced to buy millions of shares in every publicly traded company, regardless of whether they liked the CEO or agreed with the corporate strategy. They became permanent capital. The era of the lone tycoon buying and selling companies was eclipsed by the era of the faceless index fund, automatically purchasing the entire market every single day. The greatest conquests in human history are not achieved through force, but through the quiet monopolization of infrastructure. Chapter 8. Power without office. BlackRock, government, and corporate influence. When you become the largest shareholder in thousands of public companies, you accumulate a type of power that has rarely existed in human history. BlackRock, alongside rivals Vanguard and State Street, form the big three of passive management. Together, they hold the deciding votes in the boardrooms of almost every major corporation in the world. They vote on executive compensation, board member elections, and corporate mergers. They wield the weight of trillions of dollars in proxy votes. This creates a profound democratic and philosophical dilemma. Whose money is BlackRock actually using to exercise this power? The wealth belongs to everyday pensioners and retail investors. Yet, the voting power is centralized in the hands of a few executives in Manhattan. When Larry Fink began writing his annual letters to chief executives, demanding that corporations focus on social purpose and environmental sustainability, he sparked a massive cultural and political backlash. Critics on the political right accused BlackRock of using other people's money to force a progressive climate agenda onto the corporate world, weaponizing the concept of environmental, social, and governance standards. Critics on the political left argued that BlackRock was merely greenwashing its image while remaining one of the largest investors in fossil fuels and weapons manufacturers. Both sides realized the same terrifying truth: an unelected financial institution had amassed the power to dictate corporate behavior on a global scale. This backlash highlights the inevitable tragedy of scale. When you grow too large, you cannot hide behind the excuse of being a neutral participant. Every decision you make or refuse to make becomes a deeply political act. BlackRock discovered that while mathematics can protect you from market volatility, no algorithm can protect you from the furious ideological conflicts of a divided society. The ultimate risk management firm now faced the ultimate unmanageable risk: public anger. When a private entity becomes too large to ignore, it inevitably inhabits the burdens and the hatred usually reserved for a sovereign state. Chapter 9. The meaning of BlackRock in the age of invisible power. The journey from a humiliating loss in 1986 to the apex of global financial dominance reveals the astonishing metamorphosis of modern capitalism. Larry Fink and his partners built a machine to protect themselves from the chaos of human error. In doing so, they created an institutional colossus that has reshaped how wealth is managed, how companies are governed, and how governments respond to economic disaster. The individual has been replaced by the index. The gut feeling has been eradicated by the algorithm. We must reflect on the moral meaning of this transformation. BlackRock provides stability, low costs, and unprecedented access to markets for millions of ordinary people. Yet, the price of this efficiency is an extreme concentration of influence. We have handed the voting rights of our economic future to a handful of giant institutions whose internal workings remain opaque to the average citizen. We now live in a world where infrastructure dictates destiny and power operates quietly behind the screen. History teaches us that concentrated power seldom remakes itself willingly. It must be continually examined, questioned, and held accountable by the society it supposedly serves. The story of BlackRock is not merely a tale of corporate triumph or financial innovation. It is a warning about the invisible networks that control our world without our explicit consent. The next great crisis will likely not emerge from unregulated risk, but from the very systems we have built to keep us safe. If this exploration into the hidden architectures of modern financial power has deepened your understanding of how our world truly operates, please consider subscribing to the channel and leaving a like on this video. I encourage you to share your thoughts in the comments below as we continue to uncover the historical forces that shape our lives. I leave you now with one final, unsettling question to ponder in the silence of your own mind. If the machines we built to protect us from disaster now control the global economy, who exactly will protect us from the machines when they make their next inevitable mistake?